Alright, so welcome back to another video on Morningstar Investing Classroom, this North American financial firm that offers an array of financial service, management service, and educational content for investors. So here, so far, I look at the featured content, one of the 7 modules or course where you have the stocks, funds, portfolio, bond, ETF, and ESG, the environment, social, and governance. So I'm looking at the featured content and the things to know here to make a quick recap of this model of the investment is that on average uh, that stocks has provided the highest return and increase in the wealth. Investors must have discipline and patience. Looking at the crisis and long-term performance, how can see how holding on can pay off in the long run. Also, that after the end of a recession, small cap stocks, the small caps are uh, stocks whose market capitalization is around 250 millions and 2 billion. The specific number may vary according to Investopedia. So, small cap stocks, on average, the accumulated return perceived by them outperform those of the large stock after 1 month, 6 months, a year, and 3 years after the end of a recession. And how the federal fund rates, or the Feds, which is this institution that was created in 1913 that set the discount rate, something I'm going to talk about that later, the prime rate, which is the rate at which commercial banks charge to their most creditworthy clients, such as companies. It oversees the monetary policy, it prints money, it sets monetary policy, and buys and sells government security. So the Fed, they want to try to achieve the federal fund rate, which is one of the a short-term rate on the loanable fund market. This market where it has several interest rates. An interest rate is the charge of money when you borrow, or the interest you will earn when you save an account, or when you use the money in a saving account. So these interest rates in the loan markets, there are several number of them reflecting loan of different risk and time length. So the reason of looking at the federal fund rate is because this rate, a short-term rate, meaning a year or less interest rate, is the rate used commercial banks to lend funds each other overnight. So the Feds try to achieve the federal fund rate by buying and selling security in the federal open markets. And just like the stock market, the bond market is also affected by the state of the economy. So during a contraction, the demand for loans tend to fall as their interest rates, and during an economic expansion, the demand for loans increase, making the cost of borrowing more expensive with the interest rates. So, because understand this market contraction and expansion and the downturns and recovery from the big to look at the bigger picture is first allow to investors to see how performance data uh, can give you some insight, especially if you want to make long-term investments. That's one. And second, if uh, yeah, and second, if um, to look also at how risk decrease over time. So by looking at the last 49 years examination of the past capital market returns and see that there have been 10 market contractions that after the end of each of those contractions, it marks a market stock cycle, meaning a complete round of a stock price fluctuations. And this is something that can happen at random times and can last for a different period of time. So contractions, they are contractions uh, happens when the stock market peak level falls 10% or more, and an expansion is a recovery of an index from the very bottom from its previous peak and the subsequent performance until the next level peak before a decline. So the index is just this statistical reference of investment expressed as a percentage in a period of time, that the whole idea is to measure progress. And this recovery, which is this boom in price security following a long decline, this is the term used to describe is the boom economy, nation's activity economy. So the things to know here is that investors should have a long-term investment horizon to let their investments to grow. Okay, and then I look at the thing that struck me the most, which is market in terms of recovery or bear and bull markets, and there have been several in the U.S. equity market. And equity is the total value. For example, this is contextual in equity. So one definition is the assets, the total amount of assets minus its liabilities. That's equity. Uh, and this is comes from the formula from balance sheets where you have assets are equals to liabilities plus shareholders equity. Okay, but here, well, the equity is the total amount of assets minus its liability. So is the money left once you have sold, or once you liquidate all of your assets and pay off all of your debts, or you pay all of the debt companies. So understand that the equity is also the network or the capital, and can be also seen as the total amount of stocks you own in a company, or in the context of property, is the total amount, or is the total value of a property minus its liens. This legal right of someone else to possess your property with an obligation until an obligation is met or debt is repaid. And there are some several type of liens, like bank liens. So when you ask for loans to purchase a car from the bank, they issue a lien. If you're unable to pay them, they can seize your car, resell that to repay the debt, and whatever business it can come after that. The other is the judgment liens. So this is a court can seize all of your assets, and this is common on lawsuits. So this judgment liens can allow a defendant in a non-payment case to liquidate the accused assets. You also have this mechanics lien, which is a guarantee that the owner is going to pay builder, contractor, or construction firm for service rendered. So if an owner fails to do that, then you can issue a lawsuit, and that becomes a judgment lien, right? Or it can depend how that things how depend how that case gets resolved. You might get this judgment lien or not. And also you have real estate liens, that is the ability that someone else to seize your assets, or you seize someone else's assets if a contract is not fulfilled. And the point here is, especially when you ask a loan for a mortgage uh, in your favorite banks or in any bank, so they automatically issue a lien on that home until you repay them fully. And this might take time, man. 10, 20, 30 years. It's going to depend on how you organize and how you prioritize your life towards that. Okay? And also, uh, I look at, yeah, and also I look at the tax lien. Okay, which this is not created by a contract. This is created by the law, and this is very common in the taxation field when tax authority can seize some of can seize the can seize a tax delinquent, or can seize the assets of a taxpayer delinquent. They can seize their home, their vehicles, and their bank account. Again, this is one of the things. This is the a last resort way of doing that. Uh, but if that happened, then they issue a sheriff sale. It's a public auction that allows them to repay their debt. Uh, so with that, okay, and look at how the U.S. equity market has failed, or has passed through several, which is this, and how the U.S. equity market has passed through several market downturns. Okay, and the most severe, it took 12 years to recovery, and it was at the beginning of the Great Depression when the stock lost over 80%, of the value. It's 83.4% of their value. And more recently, in the early 2000s with the dot-com bubble, the stock lost 44.7%. The recovery took 4 years. And in the 2007 and 2008, during the bank and debt crisis, the stock lost over 50%, specifically 50.7% or 9%. Uh, and the recovery period took over 3 years. So the thing here is that the pattern of all this recovery is they have shrunk in time. But the question is, do you have that time to let the market recover itself miraculously, or you can do, or you might do something about it. Perhaps learning valuable skills that are aligned with the market, things like that. But in any case, the thing is that stocks are prone to loss in value for many different reasons. Okay, and then now I'm going to look at the market in terms of recovery with respect to some asset class, such as bonds, stocks, some other asset classes with some sample portfolio, and see the correlation of different assets with a broader market. So the bond yields are driven by factors like the supply and demand for loans, the monetary policy, this tool that the Fed has to control or regulate the economy, and inflation expectations. So the Fed has in its primary tool the discount rate and the federal fund rate. Right, so the discount rate is either the interest rate that the Federal Reserve charge to bank for short-term loans, or the rate used on expected discount cash or the future discount cash flow. And discount cash flow is just a evaluation method. Is discount cash flow. Okay, and the discount cash flow is just an evaluation method to know the value of an investment today based on its expected future cash flow, based on its expected movement of money in and out of a company. And because there are most of the time categorized, or it is categorized the cash flow in several fields like from financing, investment, or operation. Okay, I wonder and I ask myself, hey, so what is this? So what is cash flow? And looking at the source from the beginner guide to financial statement, beginner guide to financial statement, okay, and to have a clear idea on how to do that and to how to make sense. Because if you're able to read a nutrition label or a baseball or soccer box score, you can learn to read the basic part of financial statement. If you can follow a recipe or apply for a loan, you can learn the basic accounting, and the basic aren't difficult. So in that section, that website, the sec.gov here, so they show me how to read this basic perform. Oh, sorry, I have. Oh, all right, that's right. Mm, is this? Yeah, right now I'm using this rubber band as my orthodontics, as my dentist suggests. Okay, much better. Mm. It is quite hard to talk about this, but this actually shrink and makes me more aware to what I'm doing and how I say the things. But in any case, here what I'm doing is, well, by looking at this sec.gov and understand that that section is going to, or is designed to help me gain some basic understanding on how to read financial statement, much like a CPA class teach you how to perform a cardiopulmonary resuscitation. So that section tell me is how to read this basic part of financial statement, but it won't train me to be an accountant. Much like a CPR course will make you a cardiac doctor, but it can give you some confidence and be able to look at and be able to look at a set of financial statement and make sense of it, which is the reason why I'm looking at here the fundamentals or the basics, right? So these financial statements are from the Cuba Gooding Jr. Immortal Lines from Jerry Maguire movie. Show me the money. Show me the money. So that's what it is. This financial statement. So they show you where the company money came from, where is it now, and where it went. For financial statement, we have balance sheets, income statements, cash flow statement, and statement of shareholders equity, right? So the first balance sheets uh, show what are the things that a company owns or and what it owes at a fixed period of time. The income statement show uh, how much money a company made and spent in a period of time. The cash flow statement shows you the exchange of money between the company and the outside world, whereas the statement of shareholders' equity show is a change of interest in the shareholders in a period of time. So I'm going to look at the first three financial statements, balance sheets. It shows you a detailed information about the company assets, liabilities, and shareholders' equity. So assets are things that a company owns that has value. Either the either they can be sold or can be used to make a product or service that can be sold. So you can have physical or tangible assets, whether it's equipment, tractors, furniture, uh, or intangible items, such as patent and trademarks. The liabilities are things or is money that a company owns to others, okay? And they include all different kinds of things like money you borrow from a bank to launch a new product, the rent of use, the rent for use a building, money you own to your suppliers, the payroll a company, payroll a company owns to its employees, environmental cleanup costs, such as what happened in the Ohio recently, or taxes owed to the government. Liability also includes things that you provide to your um, customers in the future, so like good or service. Then you have shareholders equity. So the shareholders is the total amount of money if 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 a company liquidate all of its assets and pay off all of its debt. So the leftover money belongs to the shareholders. Mhm. So the leftover money belongs to the shareholders. Yeah. So the leftover money belongs to the shareholders or owners of the company. The shareholders' equity is also called as net worth or capital. So the formula that I explained later about the asset is equal to the liabilities and shareholders, this is what is used on the balance sheet, and you might find them all the company asset list on the left side and the uh, company's liabilities and shareholders' equity list on the right side. Another organization is, well, you have all of the asset list on the top, followed by the liabilities and shareholders' equity. So assets are things that a company, so assets are listed, so assets are generally listed based on how quickly they can convert into cash. So you have current assets and non-current assets. So current assets are things that a company can convert into cash within, or expect to convert into cash within 1 year, for example, inventory. And non-current cash are things that will take longer to be sold within a year. And inside of the non-current asset, we have the fixed income or the fixed assets that allow you to operate your business, such as uh, office furniture, trucks. In my case, is my laptop, keyboard, mouse, mobile, internet. Are things that are non-negotiable. They are not for sale. Liabilities is generally listed based on their due dates. So you have current and long term. So currents are obligations that a company expect to pay off within a year, and long terms are obligation more than 1 year. And shareholders' equity is the amount owner invests in the company's share plus or minus the company's earnings or losses since inception. So sometimes company can redistribute earnings instead of retain them, and this is called dividends. An example of dividends is when I look at the let's say McDonald's, right? I don't know. McDonald's is so McDonald's Corporation. Uh, yeah, so McDonald's Corporation. Uh, so here in the stockholders' equity, yeah, balance sheets like that. Uh, uh, Let me see if they have return earnings. You see, they return earnings, so they don't pay off dividends, allegedly, right? Preferred stock, common stock, additional paying capital, return earnings, right? So they don't issue dividends, right? Or they don't distribute earnings. They don't distribute earnings. When I look at EBM, I think they did that. EBM, I IBM. Yeah, exactly. IBM, some financials in, yeah, financial, balance sheets, go, balance sheets. So equity, stockholders equity, retained earnings. Mm, Let me see IBM dividends. Right, the dividend is the issue that IBM dividends yield. Okay, dividend payout ratio. Okay, well, thanks. The Nasdaq. Dividend history. IBM dividend history. Of course, they show this data like that because they don't want you to. Mhm, mhm. Cash amount, record date. A single page to review all the aggregate dividend payment information. Dividend yield, 4.94% annual dividend per ratio. Interesting. Uh, so companies sometimes redistribute earnings. Sometimes, so companies sometimes distribute earnings. So instead of retaining them, so this distribution are called dividends. Okay. And well, a balance sheet shows a snapshot of the company assets, liability, and shareholders' equity at the end of a reporting period. It does not show the flow in and out of the accounts during the period. So it is a balance sheet shows you the company assets. It shows you a snapshot of a company assets, liabilities, and shareholders' equity at the end of a reporting period. Okay, that's great for this first financial statement. Then I look at the income statement. Okay, so an income statement, okay, an income statement is a report that shows how much revenue a company earned over a specific time period, usually for a year or some portion of a year. So basically, an income statement show you how much a company show you how much revenue. And when you talk about your revenue in Spanish, la ganancia, all right? So how much revenue a company earned over specific years, uh, mhm, minus the cost and expense associated with that earning. But it's funny because it showed this. It showed this. It shows how much revenue a company made and the cost associated and expense with that earning. Okay, and the cost associated with earning that revenue. So that's the two things that this income statement shows. Okay, is the company revenue, how much revenue a company made, and the cost and expense associated with earning uh, that revenue. Okay, cost associated with earning that revenue, and the and on top of that, it shows you is how much revenue a company made in a period of time. So it might be quarterly or annually, right? And the little bottom line of this statement usually show the company net earning or losses. So the bottom line of the statement usually show the company net earnings or losses. And this tells you how much the company earned or lost over the period. Okay? So the bottom line of the statement usually show the company net earning or losses. It usually show you at the bottom line of the statement usually show you the company net earning or losses. And this tells you how much a company earned or lost over the period. So income statements also report earning per share. Interesting, because this not only show you is because income statement not only show you how much company this the income statement not only show you how much revenue a company made and the cost an expense associated earning that revenue, but also shows the earning per share. The earning per share, and this calculation tells you how much money shareholders will receive if the company decides to distribute all of the net earning for that period. And companies almost never distribute all of their earnings, and usually they reinvest them in the business. So this EPS, which is another statement here in the income statement, it also tells you is how much money the shareholders will receive if the company decide to distribute all of the net earnings to that period. And almost never companies distribute all of their earnings. Usually they reinvest them in the business. But it's important to understand these two things, right? So that an income statement shows you is how much revenue a company made and the cost and expense associated with earning that revenue. And the bottom line shows you is the company net earning or losses, and also the EPS, the earning per share, which is a calculation that tells how much money a shareholders will receive if a company distribute all of their net earnings on that period. The company almost never distribute all of their earnings. Uh, Instead, they just reinvest them, right, in the business. And it's important to understand this basics. Okay, it's very very important to understand this basic, and also when someone tells you about or you want to have this kind of conversation with someone, okay, about income statement and things like that, so you know what it is. All right. So to understand how, now this is to know the know-how. Okay, so we look at what it is, an income statement, which show you is how much money or how much revenue a company made in a period of time. Yeah, how much money a company, how much revenue a company made, and the associated cost and expense with those with earning that revenue in a period of time, quarterly, annually, you name it. So the bottom line tells you how much company. Yeah, the bottom line of the statement usually show the company net worth or net earning or losses. And also it show you is the EPS, earning per share, which is a calculation of how much money the shareholder would receive if all the or if the company distributes all of their net worth or net earning, mhm, all of their net earning to shareholders in that period. So this calculation tells you how much money a shareholder will receive if the company distributes all of their net earnings in that period. Companies usually don't do that. They reinvest them on the business. They reinvest them in the business. Okay. So that is what it is, an income statement. Alright? Then I look at to understand how income statements are set up. Think of them as a set of stairs or ladder. Again, ladder and stair are the same. It's just a ladder. Okay? It's a vertical incline set. And a ladder, it comes from the, yeah, which is a ladder. A ladder. A ladder, stairs. And she rounds on the stair, a series of steps or flight of steps of passage from one level to another. And a ladder, the structure for climbing up or down that consists essentially of two alongside pieces. ladder, or stairs. Okay, so to understand how income statements are set up, think of them as a set of stairs. Okay, it's a set of stairs. Uh, you start as a set of stairs. Mm-hmm. You know, stairs, ladders. It's kind of the same thing on Spanish. Right? So to understand how income statements are set up, think of them as a set of stairs. You start at the top with the total amount of sales made during the accounting period, and then you go down one step at a time, and each step you make a deduction for certain costs and other operating expenses associated with earning the revenue. And at the bottom of the stair, after deducting all of the expenses, you can learn uh, how much the company actually earned or lost during the accounting period. And people often call this the bottom line. So to understand how income statements are set up, okay, think of them as a set of stairs. When you start at the top with the total amount of sales made during the accounting period, and then you go down step at a time, and you go down one step at a time, and each step you make a deduction for certain costs and other operating expenses associated with earning the revenue. And at the bottom of the stair, after deducting all of the expenses, you can learn how much the company actually earned or lost during the accounting period. And people often call this the bottom line. Okay, so now I know what income statements are. Okay, so they show how much revenue a company made and the associated costs and expense uh, with earning that revenue in a period of time. The bottom line of the statements show you is the company net worth, the company net earning or losses. It also shows you is the EPS, which is um, earning per share, and it show this is a calculation that show how much money shareholders will earn if the company distribute all of their earnings in a period of time. So companies never almost never do that. Uh, in fact, they reinvest in the business. Okay. Okay. Cool. Uh, and then I look at how these income statements are set up. So you can think of them as a stair. You start from the bottom. You start from the top, and when you define the total amount of sales, mhm, is here with the total amount of sales made during that accounting period, and then you go down step by step, one step at a time, and each time, yeah, and then you go down one step at a time, and each step you make a deduction for certain, yeah, you make a deduction for certain costs or other operating expenses associated with earning that revenue. So you making deduction at each step. You make a deduction for certain costs or other operating expenses associated with that revenue. So on the bottom of the stair, after deducting all of the expense, you can learn how much the company actually earned or lost during the accounting period. People often call this the bottom line. So at the end of the statement, after deducting all of the expenses, you learn how much how much the company actually earned or lost during that period. Okay, so at the top of the income statement is the total amount of money brought in from sales of products. At the top of the income statement is the total amount of money brought in from sales. Is the total amount of money uh, from sale of products or service. Okay, so the income statement at the top show you the total amount of money from sales, products, or service. This top line is often referred to as gross revenue or sales. Mhm. This top line is often referred to as gross revenue or sales. Mhm. Yeah, this top line is often referred to as gross revenue or sales. So the top of the income statement show you is the total amount of money from sell a product or service. Okay, the total amount of money from sell a product and service. It is also called gross revenue or sales. Okay, to put in short, TLDR is called gross revenue or sales, and it is called gross because expense has not been deducted from it yet. Okay, this translated to Spanish is ganancias brutas o ingresos brutos. Exactly. And they call that gross because expense have not been deducted from it yet. So the number is gross or unrefined. Exactly. The next line is money the company doesn't expect to collect on certain sales. This could be due, for example, to sales discount or merchandise return. Mhm. So the next line is money the company doesn't expect to collect on certain sales. This could be due, for example, sales discount or merchant's return. If I look, for example, I have the Apple income statement. Okay, Apple income statement. Mm, Apple income statement. Apple income statement. Mhm. So it shows you the total revenue, operating revenue. Okay, so at the top you have um, all the money from sales. Okay, the total revenue is the total amount of money from sales of product or service. It is called uh, gross revenue. Okay, it is called gross revenue or sales because it is um, because expense has not been deducted from it. So it is so the number is gross or unrefined, and then you have below the total operating revenue. And below you have is the next line is money the company doesn't expect to collect on certain sales. Yeah, the next line is the company money doesn't expect to collect on certain sales. This could be due, for example, to sales discount or merchandise return. Okay, cost of revenue. So when you subtract the returns and allowance from gross revenue, you arrive at the company net revenue. Cost of revenue, gross profits. Okay, gross profits or gross revenue. Okay, and the gross revenue, after that you have the operating expenses and operating income, pre-tax income, tax plus provision, diluted NI available to common stock, basic EPS, diluted EPS. Okay, hey, take it easy, man. Take it easy. Take it easy. Take it easy, earlier. Take it easy. Um, mm, Let me look at this. Okay. All right. Okay. So, I'm going to make a quick recap about income statements so far. Okay. So, income statements show how much revenue a company made and the associated costs and expense with earning that revenue in a period of time. It can be quarterly, annually. At the bottom of the statement, called the bottom line because it shows a company net earning or losses. It also you can show also is the EPS, which is the earning per share, a calculation that may uh, it's a calculation that the money, okay, it's a calculation that tells you how much money the shareholders will earn if the company distribute all of its earning, all of its net earning from that period. And companies usually don't do that. They just reinvest that in the business. So to understand how the income statements are set up, okay, think of them as a set of stairs. You start from the bottom, from the top, where you have all of the sales coming from product or service. In each, when you go down, each step at a time, you deduct, okay? So you make a deductions for certain costs. You make a deduction for certain costs or other operating expenses associated with earning that revenue. Okay, so each step is a deduction of certain costs or other operating expenses associated with that with earning that revenue. So, and at the bottom of the stairs, after deducting all of the expenses, you learn how much money a company actually earned or lost. This is called the bottom line. So at the top of the income statement is the total amount of money from sales uh, of products or service. And this top is often referred as the gross revenue or sales. And gross because deduction has not been expenses has not been deducted from it yet. So the number is gross or unrefined. And the next line is money, and the company doesn't expect to collect on certain sales. And this could be due, for example, the sales discount or merchandise return. And when you subtract the returns and allowance from gross revenue, you arrive the company net revenue. And it is called net because you can imagine a net. These revenue are left in the net after the deduction from returns and allowance have come out. So the revenue are left in the net. These revenue are left in the net after the deduction. Okay, these net are left after the deduction for returns and allowance have come out. So for example, if you are see how the net fish net fishing machine, for example, okay, in a net fishing machine, in a net fishing cargo machine, but this is the machine that net making machine. No, but not net making. Um, net cargo, net boat, fish, or fishing net is this. Okay, net fishing. That's right. Similar as the net fishing. Okay, from a net fishing video. All right. So a net fishing video, right? What the hell is this?
Hello, welcome to.
What is that, right? It's a net fishing video.
Fish on the.
What is a net fishing video? It's a net fishing video. So my point here is with this net fishing video is that it explained that what left, okay, so these revenue are left in the net after the deduction. All of these other fish cannot be captured by the net. So that'll be all for this video. Take care. Bye bye.